Welcome back to the CFO's office. We have arrived at the final session of Module 2. It has been a long journey through the spreadsheets. We have set your initial capital, managed your cash flow, learned the magic of compounding, built defenses against market crashes, and even navigated the complex maze of taxes. Your financial engine is now built. It is sophisticated. It is powerful. But before we close the books and move to the next department, I have one final rule to give you. This is not a suggestion. This is a law. It is the single most important rule for the survival of you, Inc. It is the principle of separating emergency funds from investment capital. I have seen brilliant investors lose everything. Not because they picked the wrong stock. Not because they didn't understand the chart. But because they violated this one specific rule. They mixed their survival money with their war money. Imagine a kingdom. The king has an army to fight battles and expand the territory. This is your investment capital. But inside the castle, deep in the vault, there is a reserve of grain and gold. This is strictly for the survival of the people during a siege or a famine. This is your emergency fund. If the king sends the reserve grain to the battlefield, and then a winter famine strikes, the kingdom dies. It doesn't matter if the army is winning the war. The people starve at home. In you, Inc., your investment capital belongs to the battlefield. It is exposed to risk. It goes up, it goes down. It is volatile. Your emergency fund belongs in the vault. It must never be exposed to risk. It must be safe, boring, and accessible. Why is this separation so critical? Because of a nightmare scenario called forced selling. Let me paint you a picture. It is a bad year. The stock market crashes 40%. Your portfolio is bleeding red. At the exact same time, because bad luck often comes in pairs, you lose your job, or your car engine explodes. Or you have a sudden medical emergency. You need $5,000 immediately. If you do not have a separate emergency fund, where does that money come from? You have to sell your stocks. But remember, the market is down 40%. You are selling your best assets at the absolute bottom. You are locking in a massive loss. You are killing your future to pay for your present. This is how wealth is destroyed. But now imagine the same scenario with a separated emergency fund. The market crashes 40%. You lose your job. So, here are the CFO's strict rules for the emergency fund. Rule number 1. The iron wall. There must be a psychological and physical wall between these two accounts. Do not keep them in the same bank if you can't resist the temptation. Never, ever use the emergency fund to buy the dip. That money does not exist for investing. It exists for insurance. Rule number 2. Liquidity is king. Your emergency fund must be liquid. It cannot be in real estate. It cannot be in a certificate of deposit, CD, that is locked for 2 years. It cannot be in gold bars buried in the garden. It must be cash in a savings account that you can access in 24 hours. The return on this money will be low. That is the price you pay for safety. Do not chase yield with your life jacket. Rule number 3. Sizing. How big should the vault be? If you are single with a stable job, 3 months of living expenses might be enough. If you have a family, a mortgage, and a volatile income, you need 6 to 12 months of expenses. Calculate exactly how much you Inc. costs to run per month. Multiply that by 6. That is your target number. Until that bucket is full, you are not allowed to invest another dollar in the market. This concludes the work of the CFO. We have secured the capital. We have managed the risks. We have built the fortress. You, Inc., is now financially stable and ready for war. But having money is not enough. You can have $1 billion, but if you buy the wrong product, you will still fail. Now that we have the capital, what do we actually buy? Which industry? Which company? Which trend? We need a visionary. We need someone who understands the world, the markets, and the future. It is time to leave the CFO's office. We are walking down the hall to meet the COO, Chief Operating Officer. The CFO is responsible for market analysis and R&D, research and development. The CFO does not look at spreadsheets. He looks at the world. He looks at technology, demographics, and consumer behavior. In the next module, we will start with the fundamental question of analysis. How do we look at the market? Do we look from the sky down to the ground, or from the ground up to the sky? Next time, we will discuss top-down versus bottom-up approaches. We will learn how to spot the next big wave before it crashes. The CFO is signing off. The books are balanced. I'll see you in the COO's office.